Welcome to your market brief for the week of February 24th. I'm Caroline Woods. As coronavirus fears continue to impact global markets, let's start the week with perspective from Anastasia Amoroso, J.P. Private Bank's head of cross-asset thematic strategy. Anastasia, thanks so much for joining us.
Good morning.
All right, so coronavirus, global growth fears really weighing on futures today, but market's been pretty resilient up until this point. How concerned are you about the spillover, both in terms of the economy and the stock market?
Yeah, market has been resilient because we've had this base case that once you get the new cases in China under control, then that should mark the inflection higher for the markets and economic data and so forth. And what we have this morning is an introduction of new uncertainty, is that even if China may be starting to look a little bit contained, now you've had Italy, you have South Korea, you have other cases. And the reality is the markets are prone to react first and ask questions later, and that's what we're seeing this morning. You know, it's hard to tell exactly how big of a spread we might encounter in some of those countries, but like I said, the market is not looking to take any chances here. Makes sense why, because valuations are 19 times forward earnings, and then you've got a lot of investors that are actually overweight stocks versus bonds, and then let's face it, the data is going to look pretty bad over the next month or so. So with all of that in mind, and the uncertainty of how the virus spreads and how much further it's going to go, that's why we're seeing the reaction we are today.
All right, yeah, one thing's for sure, market doesn't like uncertainty, but I want to talk about for investors looking for opportunity amid kind of the current environment, amid the tumultuous environment. Let's shift to some areas where you still see growth. 3 growth trends that you believe offer opportunity: the digital transformation with AI and 5G, healthcare innovation with data and gene therapy, and sustainability with electric vehicles and renewable energy. Walk us through each. Why are you bullish, and where do you see those opportunities?
Yeah, absolutely. Digital transformation is so top of mind for all of us right now. In fact, all 3 of those are, and the reason for that, as economic growth is slowing down and as the expected future market returns are slowing down, we have to look for pockets of high disruption, high growth opportunities, and those 3 are absolutely where we're looking. But digital transformation, if you think about what is the biggest trend in tech today, you know, maybe it's AI, maybe it's augmented reality, but really it's data. And how are we dealing with all this data? It's all the data that needs to be collected, connected, processed, analyzed, and ultimately protected. And if you actually link it to some of the lingo, you know, the more technical lingo, it's collecting the data with cloud computing, and it's connecting the data with ultra-fast 5G, and then ultimately it's processing and analyzing all the data with artificial intelligence. So I think those are the trends that are here to stay really for the next 3 to 5 years. And when we do get opportunities, when the markets pull back, we're absolutely should be nibbling and inching into some of the names that benefit from that.
So how do you bet on that?
Yeah, so artificial intelligence is probably the top of mind topic at the moment, and you know there's larger cap companies, you know the likes of the technology giants, whether it's in the U.S. or China, that are providing the picks and shovels of AI. So you could definitely look at to do it there. The other thing that I would do is look at select opportunities in healthcare and logistics and kind of the worker productivity. And there's a lot of smaller companies that stand out in that space that you could add to. So really no shortage of opportunities. And the reason why, you know, I say AI, if I could only pick one thing to invest in, it would be artificial intelligence, is because it does impact so many industry verticals and companies, large and small.
So let's talk about where your concerns might be as far as coronavirus is concerned. So which of these between AI, 5G, healthcare innovation, sustainability is most susceptible to coronavirus?
Yeah, I mean, look, it's the industrial side of the economy, it's the consumer side of the economy that is most susceptible, and, you know, probably the electric vehicle, you know, rebound that we're expecting this year can be put on pause in Q1 because literally factories are shut down for the time being. But having said that, we do expect that activity will snap back, and there's plenty of spare capacity to actually make the batteries and make the electric cars, and the subsidies are being subsidy phase out is being pushed out potentially next year as well. So again, I would see that as an opportunity. But to go back to artificial intelligence and digital transformation, there's actually an argument to be made that artificial intelligence can be very helpful in controlling, in mitigating outbreaks like we've had with coronavirus. I mean, think of online food delivery, think of, telehealth and not having to go into the emergency room and being able to execute that through AI. There's actually other applications that allow you to figure out if you were on a train with somebody who was potentially infected. So I would say technology might be one of the standout beneficiaries of obviously a terrible outbreak.
All right, we have to leave it there. Appreciate your growth insights. Thanks so much, Anastasia. Shifting to a quick look at the week ahead, we have another packed earnings calendar with major companies reporting, including HP Inc. and Palo Alto Networks after the bell on Monday. Home Depot and Salesforce crossing Tuesday, followed by L Brands and Lowe's on Wednesday, and then Anheuser-Busch, Baidu, and Dell Technologies on Thursday. Turning to the Fed, I recently spoke with Jim Grant, publisher of Grant's Interest Rate Observer, who offered his take on major missteps by central banks around the world. Take a look.
Monetary heresy is the biggest threat to not only this country, but to the world. I think the suppression, the manipulation of interest rates, seemingly a kind of recondite and technical thing, is a clear and present danger to human life as we know it in commerce. I mean, interest rates are these critical prices that determine investment hurdle rates and discount cash flow. You discount future cash flows with them. And if interest rates are nonsense, if they kind of nothing, what does that say about how people allocate investment dollars? What does it say about the efficiency of corporate management's determining what is a proper rate of interest at which to choose to invest or not to invest? So I think the central banks are making a nonsense of the traffic signals of a market economy.
That was Jim Grant. To see more of his interview with thoughts on potential changes to monetary policy, head to barron's.com/video. Sticking with rates and borrowing, I'm joined now by Steve Boland, head of consumer lending for Bank of America, where he's responsible for overseeing a $300 billion loan portfolio. Steve, thanks so much for joining us.
Good to be here.
Appreciate it. So let's start with the impact of low rates on the U.S. housing market. Are they encouraging refinancing and house hunting, and where do your concerns lie?
Yeah, it's interesting. You're seeing both sides of it. Refinancing is really high, but we're also seeing that purchase activity really, really high. Clearly, inventory is tight, and so that makes it a little tough for potential homeowners. But right now, we love the activity that we're seeing and how many people really are engaging and thinking about whether it's buying, refinancing, and leveraging home equity as well.
So you've come with 3 key pieces of advice in regards to younger investors who are looking to save and create wealth amidst this ultra low mortgage rate environment. What are those 3 key pieces of advice?
Well, this is America Saves Week, and so it's the time when potential homeowners and people who are thinking about saving for other activities are out there and thinking about saving. So, first and foremost, what we say is if you're saving, save for a goal. Have a specific tracking mechanism, know exactly where you stand relative to it. As well, we're hearing from potential savers that they want kind of more information in terms of what programs are available to them, potential homeowners realizing how much they can qualify for. And then third, and I mentioned home equity earlier, we're finding more people know where they stand relative to the equity in their home. They need more information as to what they can use that home equity loan for.
So in terms of current mortgage rates, I mean, the market has been pricing in another rate cut from the Fed this year. The Fed kind of has said it's going to remain, hold pat. But should potential home buyers wait then because rates could go even lower?
Yeah, I don't think they should wait. The reality is trying to time and plan interest rates, probably not something that's advisable. And rates, I think they're close to all-time lows right now. So this is a pretty good time to be able to get in, regardless of what volatility you might see that might be driven by headlines.
So obviously we've talked about it, fears that coronavirus will impact global growth, but what do overall trends in home, but also auto financing, as well as credit card spending tell you about the state of the U.S. economy right now?
Yeah, right now, the consumer is really healthy. We saw in our most recently reported fourth quarter, savings were up for the consumer. Lending and borrowing was up by the consumer. Credit and debit card spend up 6%. We saw record holiday spend, and then credit was benign. So we see people paying their debts on time. So right now, the consumer is really, really healthy, and we're seeing really solid activity.
We'll hope that the consumer will continue to prop up this economy. Thanks so much for joining us, Steve. Appreciate your insights. Lastly, you voted on what will hit 40,000 first, the Dow or Bitcoin. The results are in, and this was actually the tightest poll we've ever had. 51% say Bitcoin will hit $40,000 before the Dow gets to 40K. That concludes today's Market Brief. However, we want to hear from you. Comment below and tell us what your best safety play is as virus fears grow. Gold, treasuries, Bitcoin, let us know. I'm Caroline Woods. Thanks so much for watching.